Two numbers, same day, 4 possible combinations. Only one of them keeps gold above 5,000, and the market has no idea which one is coming. This is not analysis, this is binary outcome, up or down, violently. February 20th, mark that date. Because on that single day, the United States will release 2 pieces of economic data that together will determine whether gold holds its $5,000 floor or breaks through it like glass. Fourth quarter GDP growth and the core personal consumption expenditures price index. Growth and inflation, the 2 variables that define every single decision the Federal Reserve makes. And they are dropping simultaneously. This is not routine data. This is the collision point. Because these 2 numbers do not just inform policy, they create it. And depending on which combination prints, gold either rockets toward 6,000 or collapses toward 4,000. There is no middle ground. The math is too broken. The positioning is too extreme. The leverage is too high. One of these scenarios triggers, and when it does, the violence will be spectacular. Let me show you the 4 possible outcomes. 4 combinations, 4 completely different market reactions. And you need to understand all of them because the one that actually happens will determine whether you make money or lose it in the next 72 hours. Scenario 1. GDP comes in weak, below expectations. Let us say 1.5% or lower when the market expects 2.3, and at the same time, Core PCE comes in hot, above 2.8%, maybe 2.9 or 3%. That is the nightmare. That is stagflation. Weak growth combined with persistent inflation. If that prints, the Fed is trapped. They cannot cut rates to support growth because inflation is still running too high. They cannot raise rates to fight inflation because growth is already collapsing. They are paralyzed. And when central banks are paralyzed, gold goes vertical. Because the only way out of stagflation is currency debasement. Print money, inflate away the debt, destroy the purchasing power of the dollar slowly enough that people do not riot in the streets. Stagflation means gold does not just hold 5,000. It breaks 5,500 by the end of the week. It tests 6,000 by March. Because if growth is weak and inflation is high, every rational actor moves capital into real assets, into things that cannot be printed, into things that hold value when currencies fail. But here is the part that makes this scenario truly dangerous for the unprepared. If stagflation prints, it is not just gold that moves, silver moves harder, because silver has industrial demand. And weak GDP growth means industrial slowdown. Factories producing less, construction projects delayed, technology deployment paused. That should hurt silver, but the inflation component overwhelms it. Because when core PCE is running at 3%, the real return on cash is negative. Holding dollars costs you 3% per year in purchasing power. So capital floods into hard assets regardless of industrial demand, and silver, trading at a fraction of gold's price, becomes the leveraged play. The poor man's gold, the way to capture outsized gains with smaller capital. Scenario 2, the opposite. GDP comes in strong, above expectations. Let us say 2.8% when the market expects 2.3, and core PCE comes in cool, below 2.8, maybe 2.5 or lower. That is the Goldilocks scenario. Strong growth with falling inflation, the perfect soft landing. If that prints, the Fed has won. They navigated the tightest labor market in 50 years, raised rates from 0 to over 5%, brought inflation down from 9% to below 3%, and avoided recession. That is the dream outcome. And if the dream is real, gold falls hard. Because strong growth with low inflation means the economy does not need rate cuts. The Fed can stay on hold through the summer, maybe the entire year. And when rates stay high, the opportunity cost of holding gold increases. You are giving up yield. You are giving up return. You are holding a non-productive asset in an environment where productive assets are performing well. Goldilocks means gold tests 4,700 by the end of the week, maybe 4,500 if the selling accelerates. And silver gets crushed even harder because strong GDP means industrial demand is fine. Factories are producing, construction is building, technology is deploying, so the flight to safety trade disappears, the inflation hedge trade disappears. What remains is just a commodity with volatile price action and no yield. Scenario 3, GDP weak and core PCE weak, both below expectations. Growth slowing and inflation cooling simultaneously. That is the Fed's green light to cut aggressively, because if both numbers are soft, there's no constraint. No inflation risk preventing easing. No overheating economy that needs to be cooled. Just a clear signal that demand is weakening and the Fed needs to support it. If that prints, gold explodes. Because aggressive rate cuts mean lower real yields. They mean currency debasement. They mean the Fed choosing growth over price stability. And when the Fed makes that choice, when they signal that inflation is acceptable as long as employment stays strong, gold becomes the only rational hedge, because the dollar is being intentionally weakened. Not by accident, not by crisis, by policy. And when policy is the source of debasement, the debasement accelerates until something breaks. Weak GDP and weak PCE means gold challenges the all-time high within 2 weeks. It means 5,800 is in play by mid-March. It means the January peak of 55.94 was not a bubble top. It was the first leg of a much larger move, and silver in this scenario does not just follow gold, it leads. Because weak growth means industrial buyers panic. They see demand softening, they see inventories rising, and they start securing supply before prices move even higher. They lock in forward contracts, they build strategic reserves, they do exactly what oil buyers did in the 1970s when OPEC created artificial scarcity. Scenario 4, GDP strong and core PCE strong, both above expectations. Growth accelerating and inflation re-accelerating. That is the Fed's nightmare, because it means their tightening cycle did not work. It means the economy is overheating again. It means they have to consider raising rates, not cutting, raising. Or at minimum staying on hold far longer than the market expects. If that prints, gold gets hit in the immediate term. Because hawkish Fed means higher rates. Higher rates mean higher opportunity cost for non-yielding assets. The market reprices, the algos sell, the futures traders exit, and gold tests 4,900, maybe 4,800 if the panic accelerates. But here's the critical detail. Strong GDP with strong inflation does not stay bearish for gold. It flips. Because if the economy is growing and inflation is rising, that is not sustainable. That is the setup for the next crisis. That is late cycle behavior. That is what happens right before something breaks. And the people who understand market cycles, who have seen this pattern repeat, they are not selling gold on strong GDP and strong PCE. They are buying because they know what comes next. They know that when growth and inflation both run hot, the Fed overtightens. They know that overtightening creates credit events. They know that credit events trigger emergency easing. And emergency easing is the most bullish possible environment for gold. So strong GDP and strong PCE means short-term pain for gold holders, but medium-term explosion. The smart money sells the spike in rates expectations, then buys back lower when the credit event materializes. The dumb money panics out at the bottom and misses the rally. Now here's why February 20th is uniquely dangerous. These two data points release in the middle of a market already stretched. Gold has traded in a 4,900 to 5,100 range for 2 weeks, consolidating, building energy, waiting for a catalyst. This is the catalyst. Manufacturing and services PMI also dropped the same day. 3 data points together create a narrative about whether the economy strengthens or weakens. 3 weak numbers mean emergency policy response. 3 strong numbers mean the Fed stays on hold indefinitely. Mixed numbers mean confusion and volatility. The specs are long. Hedge funds, managed money, positioned for weak growth or high inflation, not positioned for Goldilocks. If strong GDP and weak PCE print together, the spec long gets liquidated fast. They hit the bid. They sell futures. Price drops 3% in 30 minutes. But physical buyers stay consistent. Central banks, sovereign wealth, they accumulate through volatility. China bought gold for 15 consecutive months. Through rally, through crash, through recovery, no change in strategy. When specs panic and sell, institutions absorb the liquidation. Now let me show you the timeline. February 20th is Thursday. Markets are closed Monday for President's Day. So the week is shortened, 4 trading days instead of 5. That compresses the volatility, that amplifies the moves, because there is less time for position adjustment, less time for rebalancing. The data drops Thursday morning, and by Friday close, the market has to have repriced. But there is one more critical date, February 27th, March delivery notice day for COMEX Silver. That is 1 week after the data release, and that timing matters. Because if the data triggers a move higher in gold and silver, if weak growth or high inflation sends metals rallying, the delivery pressure on March contracts intensifies. Remember the math. 103.5 million ounces registered, 429 million ounces in open interest, a 4-to-1 ratio. If the data strengthens the bull case, if it confirms that physical demand should stay strong, contract holders are more likely to stand for delivery. They are less likely to roll forward. They want the metal, and if they want the metal, the squeeze accelerates. So February 20th is not just about the data. It is about what the data does to positioning ahead of delivery day. It is about whether the March contracts become a problem for the exchange. It is about whether the paper market maintains control or whether physical demand overwhelms it. Here's what you should be watching. First, the actual numbers. GDP expectation is 2.3%. Core PCE expectation is 2.8%. Any deviation of more than 0.5% in either direction is significant. 1.8 GDP or 2.8 GDP, both matter. 2.3 PCE or 3.3 PCE, both matter. The bigger the deviation from expectations, the bigger the market reaction. Second, The revision to prior quarters. The data does not just show Q4, it revises Q3. And sometimes those revisions are more important than the headline. If Q4 comes in at 2.3 as expected, but Q3 gets revised down from 3.1 to 2.5, that changes the narrative. That says growth is slowing. That says the economy is weaker than we thought, and that affects Fed policy expectations, even if the headline matches consensus. Third, watch the components. GDP is not one number. It is consumption, plus investment, plus government, plus net exports. If GDP hits 2.3 but consumption is weak, that is a problem, because consumption is 70% of the economy. If consumers are pulling back, growth is not sustainable. The headline might look fine, but the details are concerning, and the market trades the details. Fourth, watch gold's reaction in the first 60 seconds. The algos trade immediately, they read the data, they execute, and that first move tells you what the machines think. If gold spikes $100 in 60 seconds, the algos read the data as bullish for metals. If it drops $50 in 60 seconds, the algos read bearish. The humans then spend the next hour deciding if the algos are right. Fifth, watch silver's reaction relative to gold. If gold moves 2% and silver moves 4% in the same direction, that is confirmation. The move is real. The momentum is building. But if gold moves 2% and silver barely moves, that is divergence. That is a sign the move might not hold. Because silver is the leveraged play. It amplifies. And when it does not amplify, something is wrong. Sixth, watch the dollar. Gold and the dollar usually move inverse. Strong dollar means weak gold. Weak dollar means strong gold. If the data triggers a dollar rally, but gold does not fall, that is extremely bullish. That means gold is decoupling. That means the safe haven bid is overwhelming the currency relationship. And when that happens, when gold ignores dollar strength, the next leg higher is massive. This is not financial advice. This is pattern recognition. This is understanding that markets do not move on fundamentals. They move on expectations versus reality. And when reality deviates from expectations, positioning gets destroyed. Volatility spikes. And the people who understood the setup make money, while the people who ignored it lose money. Verify the data release schedule yourself. February 20th, GDP and Core PCE, both at 8:30 Eastern. Check the consensus estimates. Check the revision history. Check how gold reacted to prior GDP and PCE releases. The pattern is there. The setup is clear. The question is whether you position for it or whether you wait and react. The ones who position make money on the move. The ones who react chase the move and usually get caught in the reversal. Because by the time the headlines explain what happened, the smart money already exited. They bought the setup. They sold the reaction. And they moved on to the next trade. February 20th is 4 days away. 4 days to decide which scenario you think is most likely. 4 days to position accordingly. 4 days to prepare for the binary outcome. Because one way or another, gold breaks the range. And when it does, the next $1,000 happens fast.